was wondering if you could elaborate for me, I'm a new subscriber, how you approach position sizing and portfolio construction in your fund. I like a lot of the ideas you have shared and feel like they lend themselves to a very diversified approach, many smaller positions where patience can be maximized.
I'll try and make it as simple as possible. You go across multiple sectors, all of which represent deep value. Don't get overly position sized in any one sector. For us, it's roughly about a 10% weighting, often 5. Then you take that 10 or 5% or whatever it happens to be, just call it for shits and giggles 10%. Of the 10%, 50% of that, you want to have preferably in stuff that is really solid. It's companies that are not going to go away. Like free cash flow is positive. They don't have, humongous debts, all that kind of stuff. Not always achievable, but that's the premise. And then the balance, you might get a little bit more leverage. So you might take on smaller cap companies, ones with a bit more leverage and so on and so forth, which can go up much, much more than the larger cap companies. And that's basically sort of it. And so if you build a whole portfolio like that, what you're going to find is that each of your individual equity positions is typically not much more than 1 or 2% of your overall assets under management. And so then what happens is that you don't get driven by the market. So you have some particular equity, it's down 30%. You're not going to wake up in the night going, oh, Jesus Christ, what's going on? This is doing my head in, because it's 1% and your 1% is dropped by 30%. And often that is just purely as a consequence of liquidity issues or some other nonsense. And it's got nothing to do with the fundamental value of the company. And so what you allow yourself to do is to wake up and look at it and go, oh, it's down 30%. Would I buy that today if I didn't own it? And you look at the fundamentals, you go, hell yeah. And so you don't necessarily buy it, but you're in a position to be comfortable with what you're doing. And the same is true when it goes up 30, 40% or triples. So you don't let the market start driving your emotions around. And that's what I see people doing all the time. And they largely do it because they're overly position sized in one thing. They just bought Bitcoin a year ago, and now they're making so much money, but they put in, 30% of their capital into it because they listened to somebody who was bullish on it. And that's fine when it's going up, right? But as soon as it goes down, then they're not in a position to actually mentally deal with that. And so in a nutshell, that's how we manage the portfolios.
Yeah, that's a great point. I think it's, even when it's going up, a lot of times that's harder to manage the position than when it's going down. It's just an emotional roller coaster ride for sure.